Okay, so let's get going. Again, welcome all of you. Thanks for joining on a Sunday morning. Typically, on Sundays, everybody wants to relax and have some fun and just to chill out. So we will have some interesting discussion. It will be as good as the relaxation only for most of you, hopefully. So what we are going to discuss today, uh, we are going to discuss about options trading. I get a lot of queries about the basics of option trading, how to what is option trading, what are the basic type of trades in options, and how do we go about those trades. So we'll discuss about that. We'll also discuss about Nifty Bank Nifty trend for coming days and coming weeks. And maybe if you people want, I can discuss couple of stocks also, how the stocks are moving and what is the price prediction, etc. So let's get going. So before we go ahead, some of you know me, some of you don't know me. So my name is Ritin Chaudhary. By qualification, I am an electronics telecommunication engineer, and I have done a BA from SIBM here in Pune. And from 2017, I am full time into wealth management business. Till 2016, I was working in the corporate field, in the IT field. In 2016, end of 2016, I left my job and I started my own business. So this is the sixth year I am full time into wealth management services. The services that I offer are into stock market and also into cryptocurrency field. My area of expertise is there in both the areas in stock market as well as in cryptocurrency. So there are various services which are available in both these markets, stock market as well as in cryptocurrency market. Portfolio design and management services are there, advisory services are there, and I also take the trainings also. So that's a little bit about myself. So as I mentioned, what we are going to discuss today, we are going to talk about options trading. We are going to take a little bit of market update, and then we will also have question and answer. So I always share this quote with participants whenever I'm taking a session. So this is a quote by Warren Buffett. I'm sure most of you know Warren Buffett. Who is Warren Buffett? He doesn't need any introduction. So the best investment you can make is an investment in yourself. The more you learn, the more you earn. I mean, we should always try to improve our knowledge, improve our information. That's the bottom line. There is no end to learning, especially in fields like stock market trading or investment or cryptocurrency trading and investment. Learning is very important and quite critical. So keep on updating yourself, keep on gaining as much knowledge as possible. Okay, so coming to options trading. So what we are going to talk about is what is options, what type of options are there, what type of strategies you can use, and what are the precautions one should take while doing trading in options. Okay. So bear in mind, I'm not going to talk about something very advanced in options because options is a very vast topic and we can have a full 1 week workshop to discuss about options. What I'm going to do today is that going to give you an orientation about how to approach options trading. Okay. So that the expectation is clear for everyone. Okay. So what is options? Okay. So options is an instrument to trade the underlying. Okay. Now what does this mean? So let me elaborate here. But for that, I will have to share some more details with you or some more slides with you. Give me a second. Who is that? Can you please go on mute? Somebody was having some noise. So what I was saying is that options is something with which you can trade the underlying. Okay, now let's say what we are talking about here is, let's say Nifty. Let's take example of Nifty. Now Nifty is an index, right? Now if you want to trade Nifty, when I say trade Nifty, if you want to take benefit of the movements of Nifty, let's say Nifty is going up or Nifty is going down. So you want to take benefit of that up movement or down movement. So how do you take benefit of that up or down movement? Okay. So for that, we trade into something called as Nifty options. Or let's take example of some stock. Let's say TCS. You want to trade in TCS. You know that TCS is going up or down, and I want to trade in TCS. Now there are various ways how you can trade in a particular stock or in a particular asset. Now let's say you buy it in a spot. Okay, you just buy the stock and you feel that it is going up, so you'll book up a certain percentage of profit. But when you are buying a stock and you are waiting for a up move, the amount of profit that you can make will be reasonably less. I mean, let's say you buy one stock or 10 quantity or 100 quantity, whatever, and the movement in the stock may not be like 15%, 20%, or 50% immediately. It will take you for a return like 50%, it will take you years time, 2 years, 3 years, 4 years also possible. So if you want to get a good return on your money, when I say good return, let's say 25%, 50% in a very short span of time, then we go for something called as derivative trading. Now in derivative trading, there are two type of things that you can use. One is futures and another is options. Futures is something that we are not going to talk about today. We are focused upon options discussion today, so we'll talk about options only. Similarly, you can go for Nifty. Okay. Now, currently Nifty is, let's say, 7,500, and if you are expecting Nifty to go to 18,000 or 18,500 or whatever level. Now, for a 500 points move in Nifty, if you want to get a proper benefit, buying a Nifty mutual fund or a Nifty ETF is one option. You can just buy a Nifty ETF and take the benefit of the up move, or you can buy Nifty futures, or you can buy Nifty options. So that is what I mean by what is an underlying asset, and options is a way of instrument to trade the underlying. That is what I was referring to when I say instrument to trade the underlying. So any query on this point? I can take one or two questions on this particular point here, so that you all are clear, and then we can move ahead. You can put it in chat box or you can speak out. Okay, I guess it's just clear to everyone. That's fine. Okay, so let's move on. So there are two type of options particularly. There is something called as call and there is something called as put. Okay, and what are these taken for? Now again, let's go back to our Nifty chart. If you are expecting Nifty to go up, okay, and you want to take a long position in Nifty, and you want to take benefit of the up move, you are feeling or you are confident that Nifty is going to go higher, and you want to take a benefit of the higher move or the move in the upward direction, then that is when you do a simple thing. And what is that simple thing? You buy a call. Okay. And conversely, if you are expecting Nifty to go down, okay, from the 17,500, let's say you are expecting Nifty to go to 17,000 or 16,500 or whatever. So, and you want to take benefit of that downward move. If you want to move, if you want to benefit from the fall in Nifty, then a simple thing that you can do is buy a put. Okay. Now, what is buying a call and what is buying a put? I'll show you on the exchange. was having Demat fund. What is that? Yeah. ICICI Direct is something that I typically recommend for any type of trades in the stock market. Okay, so we are on the options page. I mean, if you go to the portfolio and basically home screen, then you go to F&O, and here you can basically in the F&O section you can trade in futures and in options. So I want to show you about the options here. So let's say you want to buy call. Okay, as I said, you are expecting Nifty to go higher. You're expecting Nifty to go higher. You want to take the benefit of the rally in Nifty. So what do? You go to your Demat account and select Nifty here. So you will get various options. So we are talking about Nifty. Then you select a contract. Now we come to the further details about options. Now in options, there are two important points: expiry date and strike price. Okay. Now, what expiry date to choose and what strike price to choose is part of your options trading strategy. Okay. Typically, for a short-term trade, I expect or I suggest you select the next week expiry. So let's say today we are on 6th and you are trying to take a trade on Monday. Okay. So Monday is 7th. So when you are trying to take a trade on 7th of February, you will not take expiry of 10th of February because 10th of February will be the same week. Okay, there is a reason for that why we suggest next week, and that reason is basically there is something called as decay in the options, and that decay is something that we want to tackle. So for that we will go for the next week expiry. We'll go for 17th February. So again, I am repeating, we are assuming that we are taking a trade in week of 7th of February, starting 7th of February. So there you will not go for 10th of February expiry, you will go for the next week expiry, which is 17th February. Now what strike price to select? Now currently Nifty spot price is 17,500. Let's say assume that when you are taking the trade, it is the same. So depending upon your risk appetite, okay, now you can take low risk, high risk, medium risk, okay. Depending upon your risk appetite, you can go for a strike price. Okay, strike price is the level of Nifty which you are expecting Nifty to reach. Okay, let's say you are bullish and current price is 17,500 and you are expecting Nifty to go to 18,000. Now, the closer you buy, current price is 17,500, and if you buy closer to 17,500, it will be called as at the money or near the money. And let's see the prices. Let's say 17,500 is at the money, right? So you can see here the premium is 237 rupees. Now, if you buy this 237 rupees premium, if the call goes right, you will make very good profit and very fast. If your trade is correct. But if your trade is wrong, then you will also lose money equally fast. This 237 can become 300 very easily, and this 237 can become 150 or 100 also very easily, depending upon the direction. If your direction is right, you will make money fast. If your direction is wrong, you will lose money fast. So for that, you have to be very certain about the direction. Now, of course, it is not so easy to be certain about the direction all the time. So that is where I suggest you be a little cautious and go for a slightly lower premium trade. Okay, now when I say lower premium trade, let's say we go a little further. Let's say you go for 17,700. So from 237, the premium has reduced to 142. If it is still risky for you, go for, let's say, 18,000. Here the premium is 50. Now, if you are going for a premium of 50 rupees, the movement will be very slow. If the Nifty is moving by a couple of 100 points, you will be making maybe 10 points or 15 points or 20 points. Similarly, if the Nifty is going down and your direction becomes wrong, then you will lose less money. So you will lose less money, at the same time you will earn also less money. So this is quite a low risk entry that you can take. What I will recommend in this kind of scenario, you go for a premium which is in the range of 75 rupees to 90 rupees. So let's say what is the premium here? 17,900, it is 72. Let's say we go for 17,800, the premium is 103. So there is quite a large gap between 17,700, sorry, 17,900 is 72 and 17,800 is 103, the 30 points gap. So 103 is slightly, I will say, out of the band. I typically don't recommend to buy a premium of more than 90. 75 to 90 is something that one should go for. So in this scenario, we should go for 17,900, which is 72 rupees, and you can buy this particular strike price. So expiry date we have selected 17 February and strike price we are going for 17,900, assuming that Nifty is going to go higher. Currently it is 17,500. From 17,500 we are expecting it to go higher, and if your direction is right, then you will be able to get money in this particular trade. If your direction is wrong, obviously you will lose some money in this trade, but the risk is limited. Now, any query on this particular thing, you can again put in the chat box, or you can unmute yourself and talk. I'll wait for a minute.
Hello, Ritin.
Yeah.
Mainly my question is related to the selling the option. So can we take right now or afterwards?
Yeah, I'm coming to selling.
Okay.
Yeah, I'm coming.
Okay.
Yeah. So everybody is clear with this particular buying thing. We'll talk about selling. So before that, let's take a reverse trade. Okay, when I say reverse trade, let's say we are expecting Nifty to go down. So what do we do in that case? So as I mentioned here, you have two type of trades. One is call, another is put. So call is something that we buy when we are expecting a particular asset to go up. Put is something that we buy when we are expecting the asset to go down. Okay, now let's say we are expecting Nifty to go down from here to 17,000. So what we will do, instead of buying a call here, okay, we will buy put. Okay, and then with the same theory that we want to go a little out of the money, expiry date will remain 17 February. Strike price will be lesser than 17,500. 17,500 is the current level. So we are expecting it to go down. So let's say we will see that. Let's check the premium for 17,000. Okay. I think it is still talking about Nifty, select contract, put. Expiry date 17 February. Again, we can check the premium values. So for 17,000 strike price, the premium value is 70 rupees. For 17,200, the premium value is 113. As I said, our sweet spot is between 75 to 90. So we will go for 17,000, which is 70 rupees. So that's how we trade Nifty by buying. By buying a put if you are expecting Nifty to go down, by buying a call if you are expecting Nifty to go higher. Okay. Now coming to the question of selling. Okay. Now when do you do selling? So selling is exactly opposite. Okay. Now if you are expecting Nifty to go higher, okay. If your Nifty is going to go higher, then the put that you can buy, the put is bought typically if the Nifty is going to go lower, then you will benefit in the put. Now there is another way of trading or a reverse way of trading. If you are expecting Nifty to go higher, then you can sell put. Okay, how does that work? Now, if you sell this put, if the Nifty is going higher, and if you sell this put at 70, the price of this premium will go down if Nifty is going higher. Okay, quantity 50. And when you are selling, you try to sell typically at a higher price compared to the current price. So let's say you are trying to sell at 72. Okay, so this is how the trade will look. You are trying to sell at 72. Estimated premium value 3600. Now this is something that is important. Now, if you are buying a particular call or a put, okay, you pay a premium which is a multiplier of quantity and your buying price. So you multiply 50 into 72 and you get 3600. But when you are selling, the margin required is much higher and you are not actually using 3600. You will require a very high amount. And how much that amount will be, I'll show you here. You will actually require 1,10,000 rupees instead of 3,600 when you are trying to do a sale. Or maybe I can show you easily on Zerodha here how it works. 50, 15,000, 17,000 buy. Okay, Zerodha, there are a lot of issues about the series, etc., that you can buy. That's the reason I don't prefer to use it. But I'm just showing you for example purpose. So let's say you are trying to buy it at 70. You are placing an order. So your premium required is 3,500. So just pay a close attention to this premium value. So you place a buy order. It is not letting you to place a buy order for external reasons. That is why there is a trouble. But anyways, so 3,500 is the premium required for buying this particular put. Okay, and if you are trying to sell this particular put, then see what is the premium that will be required. The premium increases straight away to 76,000. From 35,000, the premium increases to 76,000. So the point here I am trying to tell you is that for option buying, the amount of premium which is required is very less, whereas for option selling, the amount of premium which is required is very high. And there is a reason for that, and that also I will explain to you. Now, when you are buying, uh, an option position, let's say you are buying this thing, okay. So the maximum risk that you carry when you are buying is the premium that you are paying. Okay. Let's go back again here. Let's say you are buying a call. Contract. Expiry date is 17 February. Your strike price is 18,000, whatever. Okay, so the maximum risk that you are carrying here when you are trying to buy this particular contract is 50. Right, 50. By the way, this quantity 50 is the lot. Okay, the all the option positions that you buy, they have lots, something called as lots. So you can buy in lots. You can buy one lot, two lot, three lot, and a lot will have a specific quantity. So Nifty has a quantity of 50 per lot. Bank Nifty has a quantity of 25 per lot. Similarly, different stocks will have different quantity per lot. State Bank of India option has a quantity of 3,000. Reliance has a quantity of 300. Maruti has a quantity of 100. So it varies from asset to asset. But the point to be noted is that you have to buy in lots, multiples of lots. Okay. So the maximum risk that you are carrying here is 2,500. Okay. So let's say this goes to zero. What amount you are going to lose is 2,500, not more than that. So your risk is defined 100% predefined when you are getting into a buy trade for options. Okay. So that is the good point about options, option buying. Now, if you are selling, let's say you are selling at a price of 50 and your direction goes wrong. So this 50 can become 100, this 50 can become 150, this 50 can become 200. The loss that you can have is unlimited. So that is why I will mention here. Okay. So when you are buying, your loss is limited. Okay. Your profit is unlimited because this, if you are buying, then this 50 can become 75, 100, 200, whatever, depending upon the market movement. So your profit is unlimited, whereas your loss is limited. Your loss is limited to 2,500. Your profit is unlimited when you are buying. When you are selling, it is exactly the opposite. When you are selling, your maximum profit is 50 rupees because this can become zero. It cannot go below zero, right? So your maximum profit is zero. Your maximum profit is 50, whereas your maximum loss is unlimited. It can go to any level. It can go to 100, 150, 200, 250. Of course, you can use stop loss in between. But technically, the point is in selling, your loss is unlimited, your profit is limited. In buying, your profit is unlimited, your loss is limited. So I personally prefer to go for option buying. Okay, because your risk is predefined and your profit is unlimited. Having said that, there are advantages of doing option selling also. There is a concept of option decay, and if you are able to utilize that option decay properly, then selling is also a good thing. But selling is something for very advanced traders and it requires a lot of strategies, etc. And you can go for that if you want. But typically, doing options trading using buying is much simpler and easier, provided you have a good understanding or good grab of technical analysis. If you are having a good grab of technical analysis, or if you are able to take the trades properly, and if you are able to pick up the direction correctly or accurately, then with option buying, you can make a lot of money with very limited risk. So that is what I wanted to give you a perspective about option buying and selling. If there is any question on this buying and selling, we can talk about it, and otherwise we can go further. I'm not getting into strategies here. This discussion today that we are having is just to give you an orientation. It's not about the straddles and strangles and condors and butterfly, etc. So we can do a separate discussion for that. But is everybody clear about what is option buying, what is option selling, and what are the pros and cons? What are the drawbacks and plus points about option? What is the risk and benefit in option buying, and what is the risk and benefit in option selling? Is that clear, or we can spend some more time on that? Okay. Good. So let's move ahead. So that's the basic about options, buying and selling, option trading, in the money, out of the money, expiry date, uh, strike price. We covered all those points. One thing I would like to mention about trading, especially if you are doing option trading, avoid this thing called as FOMO, or fear of missing out. What happens if the market is moving in a certain direction, and if your premium is increasing? Some a lot of times people get uh, attracted, or people feel that okay, I'm missing the chance, I'm missing the opportunity, and they enter at a higher level. So don't enter at any higher level. Always wait for the right trade. The market is not going anywhere. Market is there on a daily basis. You can trade on a daily basis. If you miss some opportunity on a particular day, it is okay, and there is no need to really chase a particular trade. Just wait for a right setup, and if you get the right setup, you will be able to have a proper trade, and make the proper profit without taking too much of risk. So whenever you are running after, or when you are trying to catch a particular trade, or as we call it, you are trying to catch a running train, so to say, it is quite risky. So you should avoid that. So options trading, the precautions. What are the precautions you should take? As I mentioned, don't FOMO, don't enter into a trade enter into a trade if it is too late for you. Understand when it is too late. So that's the precaution you should take. I mentioned about the expiry. Expiry you have to select very carefully whenever you are trading in the weekly options for Nifty, Bank Nifty. The weekly options are there. Don't take the trade in for that particular week, or expiry date of that particular week. Take the expiry date of next week at least. Okay, for stocks the expiry is monthly, so that is not a problem. Secondly, don't keep the option trade open for too many days. Maximum 2 days, 3 days, if your direction is right, and if you are doing option buying, and if your direction is right, in maximum 1 or 2 days you will be able to book profit. If you're not able to book profit in 1 or 2 days, you should typically exit that particular trade. So these are the precautions you should definitely take. Don't FOMO. Select proper strike price, select proper expiry date, and use stop loss. Of course, stop loss is very important, because if your direction is wrong, then the options will decay very fast, and whatever 50, 60, 80, 90 rupees premium that you are paying, that can reduce significantly. So these are the precautions that you should typically take. So with that, I would like to quickly brief you about, all this is fine, and if you feel that you are not able to manage all these things yourself properly, then you can of course go for our services. We have a basket of services that is available from RGS. So there is a portfolio management service which we work on profit sharing basis. There is advisory service wherein we guide the clients about the trades, what trade to take, at what level to take, etc. Then we also have quarterly fixed return services and trading services. So these various services are there. You can discuss with me one on one about the details of the services. So how all these trades are taken? Okay. So basically, the foundation for all trading is technical analysis. Okay. So you should be able to do chart reading, how to detect the trend and trade with the trend, especially in options. Detecting the trend and trading with the trend is very critical. If the market is going up, you should be able to pick up the trend, and then you should be taking the long positions. You should be buying calls. But then, of course, your direction has to be right. So there are various tools for that, various patterns for that. So we also have training services. You can go for our trainings and learn the details about how to basically pick up a trend and trade with the trend. Okay. These are the various indicators that you can use. There is something called as VWAP, volume weighted average price. Then there are moving averages, various moving averages. Then there are indicators like RSI, stochastic, MACD, etc. Then there is Bollinger Bands, Fibonacci retracement. So all these indicators are there now. Many people know about these indicators, but many people don't know how to use the indicators. One particular indicator will not give you the desired results. You have to use a combination of indicators and patterns. And again, you can go for our training or you can learn it yourself. But then if you are using these indicators properly, you can get the proper desired results that you are looking for. These are the various patterns which you can study and master in technical analysis again. So support resistance is again a foundation for technical analysis. Then there are important patterns for breakout or breakdown, something called a flag, channel, triangle, pennant. So trend line, cup and handle, these are the various patterns. You need to master them if you want to become a successful options trader, or you want to trader in any market for that matter. So does this work? You can follow me on Twitter. On my Twitter channel, I keep on my Twitter handle, I keep on posting various updates, and you can really see whether there is a proper performance as per the strategies or not. Okay, I'll give you some examples. Now, if you see this particular trade here, this was a trade given, and the buy was at 69, and the target was 84 and 99, and we were able to do target to T2 done, which means 30 points were done on the T2, which means you buy at 69, you sell at 99. So a 30 points profit on a 69 rupees premium. So which is almost close to 50%. Okay, now if you want to take a benefit of 50% on Nifty in a, what do you call, in a regular spot position, then it will take you a lot of time. I mean, there's a lot of time, maybe 2 months, 3 months, 6 months, or even 1 year for a 50% return. Whereas in options, you can get that 50% return in a matter of 1 day. So this trade was done in only just 1 day. Buying price was 69, selling price was 99, and 30 points profit was booked. I'm giving you examples of the advisory trades. Again, there is a similar trade. So this particular trade was a giant 27 expiry. Then we had this trade for Feb 3 expiry. Here again, if you can see T2 done, the buying was at 87, and the target 2 was 120, and target 2 was done, and we are able to book 33 points here. So 33 points on 87. Now this was not 50%. This is like close to 30%, but still 30% profit was booked in just a 1 day. Another example here. So this is a PE position, 17,400, buy at 59, sell at 90, 75 and 90. We had given 2 targets. So here target 1 was done, target 2 was not done. So we were able to book, okay, I mentioned 31 here, it's actually 16 points. So 16 points were booked on 59. So again, close to 25% plus profit. So this is how you can actually make very good profits in option trades, provided you pick up a correct trade. Picking up a correct trade is very important. And in our advisory trade, in our advisory service, we are able to give the accurate trades quite regularly. Our hit ratio for the advisory option trades is like 70 to 80%. Of course, we give advisory for stocks also, it's not only options. So since we are talking about options here, so I'm focusing on the options discussion. So quite accurately, we are able to give you good trades in options, option buying with less premium, with less risk. You are able to generate very good profit. So that's the detail about what I wanted to share with you. Some of the important links that you can use for trading, investing. You can use investing.com. You can use TradingView. You can use Money Control. Money Control also has got some good information. So these 2-3 sites, websites, if you are using, you will be able to get a lot of good information. So one interesting perspective I wanted to share with you people. Don't a lot of people, what happens in options trading, they feel that they can make huge money in 1 day or immediately. So don't target that. Keep small targets. Keep on booking small targets. If you are making small profits consistently, we can also create very good income, very good wealth. And I will give you a perspective here. Einstein has mentioned that compound interest is the eighth natural wonder of the world and the most powerful thing I have ever encountered. What does that mean? If you look at the magic of compound interest, you will realize this and you will accept this. A very simple and interesting chart that we have here. If somebody starts investing with 1 lakh rupees and if he or she is making a 60% profit annually, okay, which is 5% monthly, your wealth in a period of 20 years, that 1 lakh can actually become 1200 crore. Now it looks unbelievable, but that is what the math is, that is what the fact is. So even with 1 lakh and with consistent small returns, you can create huge wealth. That is the point I am trying to make here. I mean, your 1 lakh need not become 1200 crore. Even if you are able to make your 1 lakh to 10 crore or 20 crore or 30 crore, it's still handsome. That's the power, that's the potential. So that is why I always tell traders, investors, that don't try to make a lot of money every day. Let's make small money every day. That small money that you are making every day or every week will gradually give you a very good return or very good corpus, very good fund in a compounding manner. So these are the details about the RGS services. You can make a note of this. These services are there for equity market as well as for crypto market. So whatever service you prefer, you can go for it. And for the details, you can contact me. We can have a detailed discussion. So that's it from my side today. These are my coordinates. Please make a note of it. I strongly suggest you follow me on Twitter. I keep on sharing various trade ideas for stock market as well as for cryptocurrency. You can join my Telegram channel.